A very good afternoon to all members present on this Ind AS refresher course, intensive refresher course on Ind AS. Today we have with us a very a faculty, a very senior faculty, and a person very I must say down to earth but a very impressive profile, C. Rammohan Bhave. Today we are going to discuss two very important standards. The first is Ind AS 116, which came into effect about 2 years ago, and it's a very complex standard which many of us fail to, first of all, sometimes we fail on the logic part, or how it is to be computed, how it is to be given effect. It's a very important standard because it has ramifications, because the normal our tendency is to think of an operational lease on an operational lease basis and forget it by charging it out P&L. But yes, this standard requires us to do something different. And also we are going to discuss Ind AS 115, revenue from contracts with customers. Again, a very important, because it affects revenue recognition, the very basis of our financial statements. And we could have not had somebody better than Rammohan Bhave sir. Sir is a chartered accountant, cost accountant, company secretary, and also holds a bachelor's in law. He is a Limca book record holder. His record is of a webinar in 2009 with maximum attendance. The webinar was on IFRS. The webinar within a span of 3 hours had 37,000 hits in 30 countries and 78 cities in India. So it's indeed a very impressive record. He has recently been awarded as the EdTech Entrepreneur Startup Award, and he has 30 years experience in industry and last 12 years experience as a mentor consultant on IFRS, Ind AS valuation, startup advisory. His total experience aggregates to about 42 years. He has worked in 7 countries, including the Reliance Group, the Mittal Group, the Chanderia Group, and he counts among his students in about 31 countries and 131 cities, and he teaches on IFRS valuation. He's also the president of the Association of Valuation Professionals and also independent director in a lot of listed companies. So with these few words, I would very warmly welcome Sri Rammohan Bhave sir. Welcome sir to this seminar. I am sure I need not take much time now. I would leave this session in your capable hands. Sir, the session is yours.
Thank you, Rahulji, and I am really honored to be in this session. And at the outset, I should share with you that I was in industry for 30 years, and last 12-13 years I am into training and consulting, apart from a few independent directorships. Having said that, a very important part, I should tell you that I am not a CA in practice. So I don't hold COP because I am on the specialized area. And after doing the corporate work, I always thought that something which I like, I should focus on. And
Right,
very appreciable initiative by WRC. And that has been continuously going on, and new teams coming in with the further enhancement of the reputation of our institute. So we are really many flags ahead. So I'm proud to be here already with 90+ participants. I will start my presentation. Please ask as many questions, and I'll be happy to answer them. And
so the participants are requested to put in their questions into the chat box. The WRC team will then take it up with will display to sir at the end of the session.
Right.
Right, sir, you can start.
The whole session will be completely practical experiences I have. I am picking up my practical experiences or the practical illustrations from 3 parts. We did around 100+ implementations of Ind AS and IFRS. Okay. I had the privilege of implementing IFRS in around 7 European countries, including London, Bulgaria, Serbia, Bosnia, for Mittal Group when I was the chief finance director there. And that is where I went through a very tough story of my career and life. And then I realized IFRS is quite tough. And after that, I came back to India. Immediately, the institute took me on the Ind AS committee, and I had the participation in the team of making Ind AS standards. The second part is then last 12 years we have done this. Then 2009 I have done Mittal Group implementation. We have implemented Ind AS IFRS. A few names are Ola Cabs, Pharma Easy, Petronas, Aris Agro. So more than 10 sectors. Okay, and we have done it for banks also from Gulf. The second part of my experience comes that in my core trainings, I have studied the balance sheets from NSC, BSC, NYSC, Nasdaq. Of course, their majority balance sheets were US GAAP, Nasdaq, then DAX, German Stock Exchange, and then London Stock Exchange. So around 6 or 7 places we study the balance sheets and make summaries of disclosures and summaries of illustrations. And the third part is our Ind AS exam, which is held, as well as ACCA London's Deep IFRS exam. Both the illustrations are available quite a lot. So good learning in terms of the standards, and particularly Ind AS 115 and Ind AS 116, as Rahulji rightly said, is a challenging task. 2nd May 2022, and this is my phone number and this is my website. These are my details, but I am always available mostly on WhatsApp because most of the times I am taking lectures. As he already told you, I am a 1980 CA, so 42 years have passed, but CA, once it goes into your blood, it is a part of your blood. And he has already introduced me, so I'll move forward. We won some award, Limca, EdTech Entrepreneur, JRRF, Asia Pacific. All right. So we are moving to revenue from contracts with customers. I mean, our knowledge as of now was AS 7 and AS 10, and also later on Ind AS 11 and Ind AS 18. Okay. What has happened really now is that all this put together, Ind AS 115 has come in. Okay. Because we were getting a revenue from both the standards, but now it has been combined, and that is a good move actually. And many places the provisions of previous standards were such that there is a dead end reached at some of the places. So quite a good amount of objective view and substance based standard has come in. Look at the very interesting thing is revenue from contracts with customers, it talks. Okay. Many times there are contracts not with the customers, and then they cannot give rise to the revenue. So one has to remember that revenue has to be from contract with customers. We will take some of the examples of that also. The various points which we need to learn arising out of Ind AS 115 are that we are able to grasp the terminology. And from the point of view of grasping the terminology, my first thought will be we must know 5 steps of revenue recognition. What are the 5 steps of revenue recognition? Contract, performance obligation, price, allocation of price, and recognizing revenue based on performance obligations performed. I will take a chance of showing you something very interesting. Are you able to see my other screen, which is called Notepad?
Yes, sir. Yes, sir.
Okay. So this is with names held up. I am discussing the story of in my own career. I will hide the years also, but this was a company in air conditioning. Okay. Now this company was having a turnover record of a very 250 crores, 300 crores, 350 crores, and something like a profit of 25 crores, 30 crores, and 35 crores. Okay, revenue and profit. Now, the owners, the family managed owners, they said, look, these are no figures. Next year, we want a very high figure. And when the budget meeting was held, and I was there as the CFO, the North, East, West, and South regional sales vice president presented the sales budget for next year, and the total was coming to just about 340. And they were saying there is a lot of recession. Whereas he wanted the turnover of 450. He said, I want the budget from all of you at 450. Every year we are adding only 50 crores. So they were shocked. Then the meeting was stopped and they were asked to go back to the dealers. The MD said, to the extent that my this year thrust is revenue. And he said, give discounts, start dealerships, spend as much on advertisement, but I want 450. Interestingly, what happened was they went back to the dealers and distributors, and the recession has again caught in further. By the time it was April to March year end, and after January meeting, another meeting was held in March. And that time they were scared. They wanted to present totality 320 and crying that they are. And then the MD then forcefully said, I can't accept anything like this. And the meeting went into chaos. After the meeting, and I had totaled up the figures and got to him, he said, Mohan, I mean, my name is Rammohan Bhave, they call me Mohan. Now that I want you to act on it. I said, sir, I can't sell air conditioners. I'm a finance man. He said, I know finance people can do anything. And then a scheme was derived. I'll tell you the scheme that if the AC was costing 30,000, we will come with a scheme of maintenance of 10%, that is 3,000. And we will give a 5 years maintenance. So that makes it 15,000. And the total becomes 45,000. And we will sell it at 10% discount, 4,500. So 40,500. So the scheme came up with a lifetime warranty, lifetime maintenance free. And the invoices were raised for 40,500. So at the end, when the sale was actually same number of units almost, the sale looked like 405 crores. Okay. And there again, we said that why not have so almost we increased the turnover by 50 crores. Now you will surprise how this can happen. Okay. From 350, I mean 300 to 30,000 to 40,000. So you add 1/3 here, around 120, and the turnover became around 470. And the balance sheet passed through, audit happened, everything happened. Now, funnily, what was the principle? Whatever is mentioned in the bill, you ask to any CA inter or the person who has started the CA course, how much will be my revenue? He said, whatever bills are raised. So all that along, we are given the impression that whatever number of sales bills you can raise, that is your revenue. And this is where the shocking treatment comes from revenue, that this 5 years performance cannot be counted at all because the performance obligation is yet to be fulfilled. So if it is yet to be fulfilled, Where is the question of we talking about having the depreciation? I'm back to my original slides. So here one will have to allocate the transaction price based on the performance obligation. So there can be single performance obligation or multiple performance obligation. All right. And that's where the what you can say is the first shock of life comes, that somebody cannot increase their revenue just by raising bills. Okay. Having said that, the recognition has to come by really many aspects covered. So we will look into some of the aspects. That is, how do you identify the contract, and how do you decide that how will the performance obligations be separated? Remember the word unbundling. I'm sure many of you already studied this, but unbundling of the performance obligation is necessary. So in a case of air conditioner with service obligation, the day AC is supplied or the control is transferred, AC sale should be booked, and the service should be recorded over 5 years in this case on a proportionate basis, including proportionate discount allocated to all elements. So having the unbundling done and record the revenue as per principles gives the rise, at many places you will find there is a liability created. For example, when you create a bill, there will be trade receivables debit and revenue credit. But here what's happening? Trade receivable or even bank, if the money is received, in the case of this AC company, 40,500 is debited, but only 30,000 revenue is booked. That too 10% discount, so 27,000. And the balance will go to liability. Liability created on account of deferred service. So one will have to think that now the bill can create only accounting for creation of trade receivable or showing the bank balance, but revenue cannot be created by just raising the bill. So unbundling of the performance obligations is a very, very important step which comes. Now the 5-step recognition is so strict that one will have to take into consideration various aspects, because each of the performance can have an implication. I will take one example also with figures. Then, can those goods and services be used on own or only in conjunction with other cases, other resources? That makes a difference. I worked in Crompton Greaves in as early as 1982 to 1991. That time, honestly, we hardly knew anything special about accounting standards. When I passed CA, there were just 3 accounting standards. Now, up to 1991, switch gears were supplied. Now, switch gears were ordered by, let's say, Bihar State Electricity Board. And I went and visited for collection. I found that the switch gear was lying in a jungle. Why? The order was placed in a 5-year plan. The transformer, the electricity, and the roads are yet to be created, but our switchgear is ready, already dispatched and lying there in jungle. No question of installing it also. You will wonder what will happen if that is to be the situation wherein the revenue is to be recorded. So one has to look at in a very systematic tree chart way. Is there a multiple goods services promised? If not, then there will be distinct performance obligations. And if the customer is going to benefit from the individual goods and services or together with readily available resources, then you can combine the performance obligation till they are distinct taken together. Let's take one case. I'll give an example. Let's say Hotel Ramada Inn. Okay. They decided to get. Can you see Ramada in my screen? Hello? Are you able to see? Okay. I presume yes. So a contractor got a contract to construct the Ramada Inn hotel in Mumbai, Pune, Nasik, 3 cities. Okay. The quotations were called for all the 3 locations. Some people quoted for all 3. Some people quoted only Mumbai, Pune. Some people quoted Mumbai, Nasik. Some people quoted Mumbai, Nasik. Some people quoted only Mumbai, only Pune, and only Nasik. By coincidence, it so happened a party which had quoted for all 3 was allotted the tender. Now, when we are talking about a progress, there were 3 parts. One was rooms, second was boarding services, and third was seminar halls. Now the question comes, should the revenue booked only when the full one is complete? All rooms are complete? These are question marks. And how they are to be decided? We have been facing the issue of construction accounting in particular. Let me give an example on construction accounting also. You know, there is a bungalow. Let us say our president has a bungalow, or our Rahulji has a bungalow, and then Hiranandani ji is constructing American kitchen, German kitchen, Chinese kitchen. Then there is a study room, there is a exhibition hall, there is an office of sir, and then there is a servant's quarter, there is a guest room, there is a swimming pool, there is a squash court, there is a badminton court. And the construction is going on, and sir has come here by his, what should I say, Tesla, new EV. And he finds that this is ready, and swimming is ready, and American kitchen is ready. Question is, he goes and enjoys that swimming as well as American kitchen. Should the contractors recognize the revenue for this part or not? Question. Second way, there is a building in which Oberoi Esquire, there are 50 stories, and we have booked a flat on 45th floor, and the work completion is only basement and some walls. Okay, and already around 35% of the cost has been incurred. Should the revenue be booked or not? Okay, question mark. Let's take one more example. There is a Mumbai Nasik Express Highway. Okay, this is the old one. I was in Gammon, India when Mumbai Nasik was constructed by Gammon India. The contract was given and they said that your new highway will start like this. Some places it will be overlapping, some places it will be like this. So please construct this part. So the some part are going to be abolished. Now at the end of the first year, the express highway was complete up to here, and then later part was not complete, so you are able to commute through the old express highway. So this benefit is passed on to the customer to the extent the new highway was complete and then diverted and adjusted to use up from that point old express highway. And take the case of flyover. Flyover is to be created, contract, but flyover is ready only up to here. Can the vehicles go? Obviously not. So should the revenue be recorded or not? So whenever I talk about construction accounting, or in the new terminology, the control is transferred over a period of time. Over a period of time. All right. Think of always a box of saying bungalow versus flat and express highway versus flyover. In this case, very difficult to find how the benefit can be passed on. And that created a big challenge when we adopted Ind AS for the first time. Now to a good extent, Ind AS 115 solves this issue wherever the substance of the transaction makes sense. So we need to look at the background. What was the position in past? The position in past was we had AS7 and Ind AS 11 almost similar, and AS10 and Ind AS 18 providing for this. Standard was on construction accounting and this was on revenue. So if we have a handover sale, that is if I'm selling a pen, okay, let's talk about goods and services. Interestingly, I'm taking a few cases. Suppose a bridge is to be constructed and here the soap is to be sold. And in case of services, here if I want to have a small AC repair handover, and here I want to have ERP implemented. Okay, this was falling under 11, but all the other three were falling under 18. Because at one time we never thought that the service industry can have long-term contracts. We used to call it a stage of completion. And here we used to call what? Where risk and rewards are continuously transferred. Okay. Sort of a qualifying asset. All right. Now, coming forward from that, the identification of distinct performance obligation has to be done. Now, what do I do for a flat? The basement is not the part of the flat. So how do I allocate them? So then, whatever old style we used to call it, handover sale or long-term contracts over a period of time, is now substituted with the wordings performance obligation satisfied over time and at a point in time. Now, for example, the word risk and reward is now replaced with what is called as control. So one tries to think over what is so much different that risk and reward and control can be different things. Have a look at this. When a particular goods, assets, service is transferred, what does the customer get? Customer gets the benefit like he can produce the goods or provide the services or enhance the value of other assets, right? Suppose I get a sofa done, but get the plywood fitted on that, which is designer. then it increases its value. Or an asset which allows to settle the liability or reduce expense. For example, when I buy a printer at home, then I'm reducing my expense of doing it outside, or xeroxing. Or that goods or services received are used for selling, resale, or pledging to secure loan, or simply holding, like people buy property to hold it for appreciation, okay, or maybe for future use. With different. Now, do we need to have all this in order that a revenue should be counted? If we start saying yes, all conditions should be fulfilled, then I'll give you some examples. Some items are sold, like SAP license is given, but you don't have right to resell. In that case, would you really call it a control transfer or not? But we are getting those software or tally software when we buy. We are not allowed to sell it. So sale with a condition of this type, will it give rise to the transfer of control or not, if we are going to be rigid about all the things to be transferred? So on one hand, there was a risk and reward. On the other hand, now we are saying control transfer, substantially benefits are required. Now here, they have made a very interesting principle. Have a look at indicators of transfer of control. What are the indicators of transfer of control? At a point in time when you do, what are the indicators? Right to payment, legal title, physical possession, significant risk and reward. So now you will see here, this was the only wording in the past standards, whereas among control, this becomes one of the 5. And then customer acceptance. A very important thing here is this A, B, C, D, E. Do you see a word and? No, we don't see. It's not given. It means all the conditions need not be fulfilled. Then have a look at, does it have a word called or? Or means any one condition filled up, fulfilled is done. No, even there is no word or also. And that is where Ind AS is substance based. So whichever thing is most applicable to that point is the transfer of control. Like many times, at one time, we had sold a car to somebody. Company sold the car to the employee. The legal title was yet to be transferred, but he started using it. Or a car seller, a dealer, Mr. P went to the showroom and wanted to test the car. So they took signature on a paper and then gave the car in his hand. And he took the car out of Mumbai and even Thane. What has happened? The undertaking he has signed was the trial will be taken within the Mumbai metro only. If you take it outside, it will be treated as a car sold to you. So this amounted to customer has accepted the asset. Revenue can be booked. So one has to be really careful in terms of seeing what all is applicable in terms of transfer of control, and we can have quite a lot of issues in this respect. Then, how do we measure the performance? So here we can think of output method and input method, performance output method and performance input method. What is performance output? If I have to share with you the old language. We used to call it percentage completion. Percentage completion. If the Nasik Mumbai Express Highway 77 kilometers are completed at the end of the period out of 187 kilometers, then you have measured the output on percentage completion. And input goes by cost. So we used to call it proportionate cost method. But now we have to get familiar with the new terms called performance output method and performance input method. We will take some examples of this. But before we go for that examples, I want to bring to your notice one more very important kind of a position which we need to be aware of. Whenever it is over time and the performance obligation is satisfied over a period of time, the customer simultaneously receives and consumes the benefit. Great. Then the asset which has been purchased, which customer is controlling, it is enhancing or creating the value of his existing assets. Great. On the other hand, the third provision or the performance does not create with an alternative use to the entity. That is, the seller cannot have alternative use, and we have enforceable right to payment. Remember this very important thing, enforceable right to payment. And this is where I'm now sharing with you, the construction industry had a problem in terms of bungalow versus flat. But under the third condition now, enforceable right to payment, if there is a milestone completion for getting enforceable right to payment, like for example, having basement completed and you pay your right to receive 25%, then even the flat sale can be booked. Of course, there are many tricky scenarios which are created. We are not going into that. But the major challenge which was created by the previous standard has been addressed, because in Bangalore you can have partial control. In express highway you can use partial express highway. But flat and flyover, the customer benefit can come only almost at the end, or even after the end, because flat requires electrification, water and whatnot. Similarly, flyover has to be made available for use, because there may be some slums, some shops. Okay. So this part actually brings a big amount of advantage of Ind AS 115, where clarity in terms of whether the risk and reward is transferred or not is taken care by having a clause on enforceable right to payment. Having said that, we have a situation in various cases where the revenue, when recognized, okay, is containing many elements. So if there is a material, labor, overheads, profits, how to account for them, where to use performance output or performance input method, is that accounting policy choice? All those issues need a very clear cut. Therefore, you must have heard that in US GAAP, perhaps different industry sectors have special applications, whereas Ind AS fortunately covers revenue standard for all in 115. But sectoral issues, whether it is a construction industry or whether it is an automobile industry or whether it is a agricultural industry, agricultural sector, pharma sector. Take for example, pharma sector, the medicines get expired, what do? They are sold to the trader and the medicine gets expired. What should be the accounting treatment? When the revenue should be booked? How much should it be booked? Bring it to the principal. So I'll make firm statements. Take first 5-step recognition, wherein allocation of multiple performance obligation and applying the proportionate discount unless it is particularly marked against any product. Unless it is marked against any product, you will have to work on proportionate allocation. So let's say there was a machine which was sold normally at 60,000 and annual maintenance contract is given at 1,000. For 4 years, 4,000. Against this 64,000, the whole thing was sold at 51,200. How much will we book for machine? How much will we book for? So here will be a discount then. Right? You can see here the discount is how much? 20%. Okay. So when you apply 20% discount, it goes for 48,800 and thereby 3,200. So when the machine is sold, we will book 48,000. But the money is received fully, so the difference will be shown as a liability. Okay. And that liability will be classified first allocated over the period of 4 years, and the balance part remains in liability classified into current and non-current. Then you will also face some issues which I faced in a company called Palm Glat. You can see this is a company which is in Dahisar, Borivali. This Palm Glat is having a Germany manufacturing. Glad is a German company and Palm is an Indian company, and their collaboration has brought this machinery supply. Now the machinery supply happens in different ways. Okay. And the installation is also a big process. So when to book that? That also becomes a challenge. So we will take those nitty-gritties further. Then, is the single method to be obtained used consistently? Yes. Especially when the performance obligations are similar and circumstances are similar. But come to a situation of Gammon India, where at one time we were finding difficulties. Then we made even within that sectors, that is water pipeline sector, residential sector, electrification sector, commercial mall sector, because the methodology of measurement of performance obligation was different in each of the segment. A similar thing I can tell you about air conditioning companies. They have central air conditioning, they have packaged air conditioning, and they have room air conditioning as well. Okay. So everything might require a different list. Thinking of room air conditioning, if you buy an AC and if you buy a fan on 29th March, fan was installed on 2nd April, delivery was received on 29th March, and AC was installed on 4th April. Which revenue should be booked? The answer is fan revenue should be booked, because the installation is simple, anybody can do it. Whereas AC revenue will get booked because of the complex installation, the benefit can come only after the installation is complete. So fan versus air conditioner can be a very concrete example of simple installation and complex installation. Now this gives challenges to many different issues. Let's take a case of L&T. L&T Infotech we were discussing. A very interesting case came through. L&T Infotech, okay, LTITL, gets the turnkey projects. Turnkey projects. Okay. Now, what is the turnkey project? Let's say an ERP implementation which has hardware, software, and implementation of the software. Now, generally, what happens is the customer, what he does, imagine the situation at our home. Let us say we want to make a wooden bed. Do we buy wood separately? Do we call the carpenter separately? And do we do the polishing separately? We never do that. We want a single man responsibility. We tell him, you get the wood, you do the carpentry, and you get the polish wala. I don't want to get into, because otherwise three of you will blame each other. I don't want to be in the multiple processes. So the customer, L&T primarily supplies only implementation. But the customer says, look, you want to implement SAP with me, you buy the hardware. You, again, in terms of software, what I need, which version, how, you guide me and I will buy. But I want to buy through you. If that is not happening, then what happens? You will say configuration mein problem hai, software ka version purana hai. Though they know the published prices. So what happens is, the hardware cost is something like 19 if they buy directly, but they pay to L&T 20. And software cost is around 9, but they pay to L&T 10. And implementation, they charge 10, let's say, or let's say 15 for simplicity and separate figure. And this is only a figure known to L&T. The total contract is 45. And a known cost to customers are 28. Now look from L&T's side, how much could be this? Normally, you know, ERPs are implemented with at least 50% margin. So we will take 7 as a cost. Now, when we have 35 as a cost and 45 as a revenue, one might say that on percentage completion, the new name, performance output basis, I will have a situation of 10 by 45 to be charged when hardware is purchased. So in that case, what will happen? L&T will have the sale booked, and how much will be the profit shown? Almost half the profit will get shown. Is that correct? The answer is no. Majority part of the profit is here. And this is more called as a pass-through transaction. Pass-through transaction. So on one hand, if we have 2-3 performance obligation individually to be performed, the performance and the profit margins will be different. And wherever there are pass-through transaction, we cannot apply this on substance based. Right? So these are the challenges which are needed to be addressed. Whereas in the normal case, we would have gone by the ratio, because there may not be any pass-through. All right. Then reliable measurements, early stages of contract. One can follow cost method. That is, revenue equal to cost. Revenue is equal to cost. Now we come to a very important topic called variable considerations. Now variable considerations can take place on account of various factors. Okay, there may be some incentives, there may be some performance based benefits, there may be, let's say, fixed come variable price. What should be done in such cases? Wherever there are variable prices, you are supposed to take either of the two methods. And which are the two methods? I'll take you to those. Expected value method and most likely amount. Okay. Expected value is like a weighted average. Weighted average. And most likely is like a, what do you say? This is mean, arithmetical mean. This is mode, most likely. Okay. So this goes by the management expectations about forecast, historical, current, and forecast factors. Okay. So all those have to be taken into consideration. How much is balance? How much is the past record showing? Generally, we have the habit of taking based on the past percentage. I will expect that customer will be paying this much, or this machine will perform this much, and it will go by that. As far as penalty is concerned, we have taken a deviation from IFRS, but otherwise, the different possible considerations should be taken. I'll give you an example here. There was a case where the year end was March. The item was supplied on 1st of February. And if the price is paid by May end, okay, then 8 lakhs is payable. If the price is paid by June end, then 8 lakh 10,000 is payable. And if it is paid by July end, then it is 8 lakh 20,000. So these are all variable considerations. So how will you decide that what should be the revenue? The answer is check what is customer style of payment or customer's financial health. So based on the track record, behavior of the customer, the management may come to a conclusion that this is they will pay by May end because they would like to save the extra cost. So it's like a inducement to make prompt payment. Okay. So in that case, what are you using? Most likely. We are using the most likely amount. So let's say in our case, the most likely amount was June end payment and 8 lakh 10,000. Now what happens? By March end, the accounts are closed. And the AGM has approved accounts on 15th May. Up to this date also, we are not aware whether this or this or this should be done. But let's say by May end, the payment comes. Revenue is booked at 8.1. Payment comes by May end. We have to reverse 0.1. On 31st May, payment doesn't come, we are happy. And if it comes in June end, nothing to be done. And it doesn't come on 30th June also, then we'll have to book an additional revenue of 0.2. So the revenue continues to be considered in case of variable considerations. These kind of situation arise, I have seen especially for the imported machinery. Imported machinery, people put a clause that it must give me so much tonnage capacity or so much speed of the machine. Then I will pay you so much consideration. Many of the companies where I worked, the foreign engineer used to sit, like for example, Garware Polyester, Aurangabad. There is, or you take Navin Fluorine in Surat, where I worked for 5 years. We always used to have some machineries protected by the engineers coming from foreign countries, because their consideration was dependent on that. So expected value, you can see here most likely amount. Now somebody will ask me, what is the possibility of using the other method, that is expected value? Where are you likely to use expected value? Yeah. So we said that May end 8, June end 8.1, July end 8.2. Many of us might get tempted to call it not as variable consideration, but as additional interest charged. But that concept is not taken up by Ind AS 115. It says that if interest was to be there, then it should be beyond this also. So it is expected that it will be paid in either of the months. So based on most likely amount, I'll use Excel to make my point further clear. I hope you are able to see my Excel. I'll increase the font size so that. So we said May 800,000, June 810,000, and July 820,000. So the management judgment will pay in June. Recognized revenue 8.1. This revenue. But let us take, this is therefore called as most likely amount. But let's say we want to find out where and how the expected value will be used. Expected value. Here, the condition is part payments allowed. Part payments allowed. So let's say management expects 40% being paid in May, by May end, another 35% paid by June end, and 25% paid by July end. So in that case, we use weighted average, that is expected value. So here, the consideration will be different. Yeah. So we will have the consideration of, and the formula auto sum, we will have a situation of 8,08,500, as against here we had got the most likely amount of 8,10,000. How? Because here the part payments were allowed, but they will be considered at that price. So which method is to be used depends. Having said that, we understood what is expected value and the most likely amount. Okay. Again, it says that one method should be consistently applied unless the situations are totally different. And historical, current, and forecast situation should be considered. A variable consideration can lead to big challenge, that high probability of significant reversal. Then it should not be. It should not be booked. Okay. That it shall not occur. If there is uncertainty, it should not occur. Now, uncertainty can be having many issues. Okay. Can you reach the delivery by this date? Commonwealth Games were to be performed in Delhi, and that time one party had got a contract to create a football stadium. If it happens by June, you get so much money. If it happens by December, you get the normal money. And if it happens after December, the Commonwealth Games have started and you are struck off, you get zero. Then we come to refund a liability, therefore is needed to be created. Now this brings to our mind, what is the position of right of return? Okay, sale or return. In these cases, how should we compute the revenue? Now, unlike past, where the sale or return clauses were so strict that unless the return period is over or unless it is sold to third party, you cannot record the revenue. They were finding it too much theoretical. So again, instead of excess conservatism, prudence is brought in. What does the prudence say here? Prudence says that, look, if you are going to have a right of return, then look at the actual situation. A right of return can have two types of products. One, a sale like Amazon, a sale like a car dealer, sale to car dealer, or sale like medicine. Okay. What is the difference between the two? The difference between the two is that in case of medicine, expired products can be returned. Rather, they are not returned, they are destroyed. So here the principle is different. Whereas here in Amazon, Amazon says you can return within 1 month or 7 days. What is their concept? Customer confidence giving statement. Our products are such that you cannot return at all. It will be so much good. And of course, they sell very cheap. On the other hand, the car dealer is a third party seller, and the car sale happens based on the customer's taste and preference. So here it is not the customer confidence giving statement. The manufacturer allows him, because the car goes by color, type, model, etc. So he will rather divert if it is not getting sold. So there you have to apply a different principle. So customer confidence giving statement versus depending upon taste and flavor of the season. Okay. The treatment is different. In case of first case, you have to apply a percentage based on the past. And in the second case, it is more of a dealership nature. So you have to book the sale more conservatively by having the resale happening. Then we come to significant financing component. This terminology is quite different for us. What is the difference? We are familiar with finance cost, finance income. If you want 30 days credit, I will charge you 1% extra and all that. Now, since globally the rates are low, the provision kept in the standard is said that as a practical expedient, no adjustment is required if it is 1 year or less. Now, frankly, in India, whether this survives or not is a different issue, because suppliers' payments are normally 2 months, 3 months, 6 months, and cash price and the payable price certainly differs. So, not counting the finance income is possible up to 1 year. And here it also gives other way around. It can be an advance payment or payment later. In both the cases, finance cost and finance income is required to be recognized. Non-cash consideration. Okay. Now, non-cash consideration has to recognize at fair value, because the fair value will change depending upon what item you are selling. Then there are clauses for sometimes you have to pay the consideration to the customer. These have got similar provisions what we had before. Then standalone prices and separate prices and discounts using residual approach is also quite. Then we talked about variable contract. We are talking about modification. Okay, let me come to the modification. Modification of contract, one has to see whether the modification is actually extension of the original contract and it could have been negotiated together, or is it that the modification is actually a full-fledged addition of another contract. So then it should be treated as a separate contract. Now this is again substance based. So everywhere when we talk about substance based, we are bound to face the challenges, and particularly as an auditor, one has to be very principle oriented and see how he can get the various factors put in. All in all, I will make a summary readily available for my friends here of the new terminologies to be used. So what do we call it? We are moving from risk and reward to control, in which 1 out of 5 is risk and reward. Then we have learned something called as at a point in time. In the olden days, sorry, this is new. In the olden days, we used to call our handover sale, like pain, soap. Then over time, transfer of control over time. Here we used a significant period of construction or stage of completion. Then we have learned variable consideration, which was going by judgment, or which is going by judgment. We used to call it a finance income, or let's say interest charged for delay, for deferred payment. Now we have a global polished language called significant financing component. So if you are an auditor and you go to a new client, you can easily confuse him by new terminologies, and perhaps he will be scared of Ind AS 115. Then it talks about the nature of accounting, that is weighted average or most likely. Then very conservative approach for sale or return. Now it is a practical approach. Then in the past we used to call it percentage completion. Now we will call it performance output method. Now does the spirit differ? To an extent, yes. Because we have moved from proportionate cost, now we will call it performance input method. I will share this also with our sir. And the biggest issue which is solved now, enforceable right to payment. This is a good news for construction. Otherwise, it used to be a challenge. Okay. So I have captured some of the terms which are new. Of course, performance obligation satisfaction will come in your disclosure notes 10 times, whereas here we'll say transfer of risk and reward. Here we'll talk about performance satisfied and control is transferred. Then you might have heard about right of repurchase. That should be taken into account. Right of repurchase. What is the right of repurchase? Some companies, let's say P, sells to our bank a property, whereas P continues to use it. And actually it is a financing arrangement getting into a mode of showing sale. So those things have to go by substance again. Cost to fulfill contracts is also covered here. A very important point before I go to the two parts, I have to now cover 3 points mainly. Contract asset, contract liability, then BOT and BOT contracts, and the barter. Okay. So let me cover contract asset and contract liability. There is a possibility where the contract assets get created, but the milestone based situation has not happened. So let me explain this with an example. Let's say this is a Mumbai Nasik express highway. I originally belong to Nasik, so it's my pet example. 187 kilometers. And government has said that you can have billing done when 50 kilometers are completed, 100 are completed, 150 are completed. Bill can be raised only in this time and the last one. On 31st March, company Gamma had completed 77 kilometers. Should they book the revenue of 77 kilometers or 50 kilometers? The answer is 77 kilometers, but 50 will go in trade receivables and 27 kilometers will go into contract asset. Okay. Like our old name used to be unbilled revenue or accrued income. Now that's called as contract asset. Similarly, if 100 items are sold and there is a right of return for 3 months and the year end has happened, then management estimate 4% will be refunded. Then you create the revenue only of 96. and say bank or trade receivable debit 100 to contract liability of 4, okay, or refund liability of 4 based on the estimates. So you don't have to wait for 3 months. It has not become that much conservative. Then I come to BOT and BOOT. I'm sure you're aware of it. Build, own, operate, transfer, or build, operate, transfer. I'll come back to Gammon India example. Does government pay anything to Gammon? No. What they say is that the next 28 years you collect the toll. Okay. And the toll rates are given in the form of a bid. So now the question is, what should be done? So when Gammon is constructing the express highway, is the express highway owned by them? No. That is anyway government, because on the government's land with government's permission you are constructing that. So you cannot take the highway in your books. So you have to take revenue. And then what will you take to debit? Because 3 years took for construction. So the debit is toll collection rights as an intangible asset. Okay. Now what is toll collection right? Present value of future expected collection. Discounted at. Now after these entries are passed, what happens to the subsequent years when the toll collection starts? The right, that is the intangible asset, we amortize depending upon the projections taken. Okay, because many times the rate starts going up. Okay, as you see on the toll rates are going up. But the final toll received has 3 parts. One is the present value, second is the discounted portion, and the third is difference between actual versus budgeted forecast. So the present value goes to revenue. The discounted portion which is now achieved comes to finance income. And actual versus forecast difference again goes to revenue, or I would say P&L, because it could be positive or negative. So that is about build, own, operate, transfer, or build, operate, transfer. Now obviously it gives very, very funny pictures, because we have companies which were closed afterwards, and then they had issues on who holds the toll collection rights, X, Y, and Z. All right. Now having said that, we come to the challenge of the third part. I said contract asset liability, I said build, own, operate, transfer, and I said barter. Now barter, the first slide I actually did not touch, which I'll show you. What does the barter say? A very interesting thing. And perhaps it bears in mind something different. Okay. Now it says that non-monetary exchange, is it covered? Non-monetary exchange in the same or similar types of goods and services are not covered by this standard. So that's the beauty of this. So let's look at what do we mean by that. Let's say there is a oil company in Delhi and supplying to Lucknow, and there is another oil company in Chennai and supplying to Bangalore. Okay. One day, the Lucknow customer started a branch in Hyderabad and placed an order on oil company for supplies to Hyderabad. Delhi Oil Company tells Chennai Oil Company to supply on their behalf. Bill is raised by Delhi to Hyderabad bill, and supplies from Chennai to Hyderabad, and payment is made again by Hyderabad to Delhi. The question comes, the non-monetary exchange clauses say that Delhi company will not pay cash. They will return it in the form of oil as and when Chennai's northern region customer is wanting. So logistically, they want Chennai to supply. So arising out of that, they are saying that, look, ensure that we will pay you in form of oil. Now here, in past, we would have perhaps thought Chennai will raise a bill on Delhi. The answer is no. Chennai will not show that as a revenue. It will perhaps show it as a non-monetary receivable and, let's say, inventory receivable. And they will credit it to their cost of sales. Instead of, in past, we would have done it, trade receivable from Delhi to revenue. But this cannot be done for the non-monetary exchange of same or similar products. So with this, I am concluding the first part of my lecture, that is Ind AS 115. And if the WRC permit, we can take those questions first, or else if you want it to be taken at the end, that is also fine. Can somebody please guide me? Should I take the queries on the revenue now? Vaibhav, Rahul sir? Okay. Hello.
Yes, sir.
Any questions on revenue I can take now, or should I take all at end?
नहीं सर, एक भी क्वेश्चन नहीं है सर.
हाँ?
एक भी क्वेश्चन नहीं है सर.
Question नहीं आए हैं?
नहीं सर.
Okay, there are no questions so far. Okay, okay, fine. So that gives me a satisfaction of perhaps that you understood the standard, or you already know quite a lot, or I have simplified it well to get an idea. It does happen that in the practical situation, many of these situations we may not face, especially variable consideration or interest cost beyond 1 year. But yes, the tricky scenarios do arise. Now we will move to leads. Okay. Whenever I start teaching leads, lot of people ask me, sir, what is hire purchase? And what is installment payment? I simply tell them to please forget these terms now when it comes to accounting. You say leads. And with the new standard coming in, the lease situation has resulted in a very interesting thing, because all these days we were talking simple things, finance lease and operating lease. Now we say everything is operating lease, especially from the leases perspective. Why? How? Because we are saying that he has a right to use. Okay. Now, how do you create right to use? And why this standard was brought in? The standard was brought in primarily because the long-term commitments were remaining hidden. Long-term commitments were remaining hidden. What is long-term commitment? Since I am a fan of eating sweets, I always give this example that there was a chocolate shop of P and R doing very well. Revenue was very good, equal, costs were equal, and rents were also equal. Rents were also equal. Now the question is, a multinational who are in chocolates, or maybe Mukesh Ambani wants to take over these shops, chocolate shops, and they say, look, I want to buy these shops. Will they pay more amount for P or R? That's the question. The shops are in same locality, both are doing well. The only difference is P is taking it on yearly rent, whereas R has rented that property for 10 years period. Here it is annual renewal happening, here renewal is happening after 10 years. The question which was asked was, should we pay more money for P or for R? Think over in your mind, and in case you have anything to speak, feel free. All right. So if there are no typical positions taken by anybody, by the India centric knowledge, we are likely to say that R should be paid more. Why? Because the property prices go up generally, barring Corona. So the 10 years contract will ensure that the rent amount does not increase. Unless, of course, it is inbuilt into the 10 years contract itself. But here we are presuming it was a fixed rent. And in fact, since this was for 10 years, the rent charge was little lower. The question comes, is this getting properly reflected anywhere into the balance sheet? Or are we saying that this is yearly charge? This is yearly charged. All right. And this is where, particularly starting with airline industry, if you see the balance sheet of SpiceJet, or now of course we should talk about the foreign airlines, because in India, Kingfisher gone, Air Deccan gone, Jet gone, or coming back, Sahara, and Air India now shining again, all such things. But the question remains that airlines, wherein we have a situation of flights who are under dry leasing or wet leasing, their balance sheets show only rent cost in P&L and the fact that the lease period is 20 years, that onerous liability does not get reflected. Tomorrow, if the business closes, still the rent will be payable. I have personally faced this problem when I was in USA. I was working for one company called foundsoft.com, and we, because of recession, had to wind up a few offices in America. We had New York office, California office, Texas office, but all in one we did it at New York. And then it became a challenge because the property which was taken for rent for so many years, or the Xerox machine taken on rent, furniture taken on rent, because in US mostly things are taken on rent, we had to pay through our nose, because the contract said that if you terminate the agreement early, you have to pay immediately. And there was no concession. We tried to negotiate and all, but it was tough. Now we decided that we will perhaps keep the Xerox machine somewhere, but in USA the transport costs are also so high that it's not worth keeping. So within the building itself, we tried to sublease that. But that is where the board or the owners can get a shock of their life, saying that if I had closed, all my costs should also stop. But they don't. And especially on lease, there are long-term commitments. Okay, there are long-term commitments for which at any point of time, no provision is there. Though we call it as a going concern, perpetual entity, it does happen that the business models change or the new variety of the machine comes, and then we don't want to use inefficient machines. It used to happen in 2000. The programs were upgrading so much that every 6 months we were requiring to change the computer. Right. Now this standard does not apply to some of the things like agriculture, exploration, some of the intangible assets like plays, video recording. So if you're Balaji Telefilms, don't expect that I will be using this. Intellectual property. Here again, we have 4 or 5 steps. It should be an identified asset. What is identified asset? Let's say we have taken a car on rent from one car rental agency. Now agency says that I will give you the car, but whichever is available out of the 50 cars I am having. Is it an identified asset? No. In that case, this standard does not apply. It means standard not applying means primarily creating an asset called right of use of asset at the present value and creating a lease liability at the same present value is not required. Of course, right of use includes direct cost also. We'll come to that. Then do you have a right to control use? When I was in Reliance, Dhirubhai Ambani Knowledge City, Mukesh Ambani, Reliance Infocom, we had rented buses and the buses will ply on the particular route. Now one day there was a huge traffic jam. The monthly consideration was already agreed upon, but a longer route was required to be taken. Am I controlling the use? Then I'll say, look, here is a traffic jam, leave this route, go by other route. Of course, in Mumbai, that is very difficult. Going back is also difficult. But If you're not controlling the use, the driver or the owner of that car rental agency will say, sorry, your kilometers are fixed. Let my bus lie there for 3 hours in traffic. Then you don't have right to control use. Then there was a question that on one route there was one bus, on another route there was another bus. And one day we decided the fact that we will use this bus for employees picnic. Do you have that right? Do you have that right? If you don't have that right, then sorry, it's not falling under the lease as implicit in Ind AS 116. That is creation of right of use and lease liability. Then the right to direct the use. Now here very funny situations come. One day the company had lot of old goods and computers were to be carried. The owner said, sorry, this is only passenger vehicle. You cannot carry luggage. Now, should it be called as not giving the right to obtain economic benefits? The answer is no. The answer is that passenger vehicle, the basic expectation is passengers should be there. So there, the contract can become a lease, no doubt. And even though the identification as lease will be satisfied, though the economic benefit which you are trying to make out of it is not there. Or let's say the vehicle has a pass within Maharashtra only or within Gujarat only. Then if you try to take the picnic out of state, well, there is a legal limit. So the legal limit, certainly. Then where should you keep those buses? Or where should you ply those buses in the night? At the owner's place or your place? That doesn't really determine criteria. So far as you have control over use, direction to the use, and substantially all economic benefits. So one has to look at it in substance. What is the right to control? Obtain economic benefits and direct the use of identified benefits. Of course, a bus fails and at that time the supplier gives a replacement bus for a day. That is okay. So if there is a substitution right, then it's fine. Then protective rights of suppliers, that is compliance of law, as I said. They are, yes, they still cover the concept of having a right to use. Then we come to consideration allocated to each component. Consideration allocated to each component. In such a case, the standalone price should be calculated as if it is a separate price of each component from a similar or same supplier. Now the word expedient is used. Expedient means necessity. Out of practical necessity, there may be situations where we will not split the components. Okay. Let me give you an example. In a particular case, some doctors, a group of doctors, rented the rooms in hospital, a particular hospital. and then they also rented operation theatre. And at the time of operation, you need gloves, you need rui, you need cotton, you need spreadsheets, bed sheets. So consumables, primarily consumables. All put together, the annual rent agreed was 5 lakhs. And the contract was for 5 years. So the 25 lakhs needed to be present valued and asset and liability to be created. I hope you already know that you create asset and liability. Now, this consumable, however, is not a rent part. It's a non-lease component. So the question comes, should this 5 lakhs be split into 3 parts? And this part should be shown as sale and not lease? Or should it be combined as a one contract and account for? Here they have said you have a choice. If it is too much of a nitty-gritty, the consumable portion is smaller one, then you need not do it. They also give the exemption for low value. For example, a company had rented few laptops. Now the company was quite big. Few laptops were brought in for a few traveling employees. They were very low value compared to the size of the company, turnover of the company. Though the laptop was rented for 3 years, considering the low value exemption, it was not treated as lease and neither asset nor liability is created. So the rent accrued was charged to P&L. By the way, this has also solved the past problem of straight lining. I'm sure you must be aware that in operating lease, we had the concept of straight lining. And that straight lining always used to create a problem because inflation-based rents go up. Having said that, there could also be a situation of lease period of 8 months. And 5 months are falling in 21-22 and 3 months are falling in 22-23. Should you create asset liability? The answer is no. The period is small. There is no great thing you can achieve by creating asset liability. Why 8 months? Even 1.5 years also. Even 2 years also, you can take a practical call that I need not create asset liability. So short periods, low value, yes. But there could be some assets which are taken on lease by way of small items, but they are required to be attached to the network server and which is also taken on rent. So the asset which work together, though individually are the smaller amounts of lease, if they work in conjunction with each other, then you need to have the asset liability created. Like you remember, in disclosure notes, we are putting list of capital commitments. Why? Because that shows the long-term plan and long-term responsibilities on the company. Purchase order outstanding for capital items. Similar way, this lease should give an idea about. Sometimes it's possible that the standalone prices may not be readily available. Now that's the challenge. The prices are not available, we have to observe them. If they are not observable, still there is a challenge. Then this is one thing which shows us substance based. A lease term may be non-cancelable or having extension option or leasee having termination option. Okay. So for example, let's take a case where the rent charged was 1 lakh per annum and the rent period was 10 years. And another contract where rent period was 10 years, but first 3 years you cannot cancel the contract. Early termination not possible. Non-cancel. Now, can you tell me, in this case, if the rent is 1 lakh, in this case, rent will be lower than 1 lakh or higher than 1 lakh? The rent will, of course, be what? Lower. Because the leasee will say, if you are not allowing me to cancel for first 3 years, then obviously I will pay lower rent because you are locked in condition. Then the next possibility is that this 1 lakh becomes 1,20,000 if you want to extend it at the end of 10 years to another 5 years. Okay. Should I calculate the present value based on 10 plus 5 years or 10 years, or in this case 4 years or 5 years or 7 years or 10 years? Question mark. So there again, substance based management judgment has to come into picture. That is, what is the possibility that it will be cancelled in 4th year? Or if there are non-cancellation clause, what is the possibility that it can be cancelled even within 1 year? What is the possibility that rent will be extended by 5 years? So imagine some situation, the business started doing very well. When the business started doing very well, then the company hired one more shop. Okay, one more shop was hired, and then there also the rent was 70,000, and that was hired at the end of the 6th year here for 10 years period. The very fact that this was hired for 10 years, there is a clear possibility that this extension will be taken. So in that case, on that date, we should recalculate the remaining rents, including the rent for 5 years, and change the present value. Change the present value. So, in all, what are the possibilities in terms of lease rent? One element is period of lease. Another element is number of items leased. Let's say you have leased 10 computers, and at the end of 5 years, you realize that I need 5 more computers or 7 more computers. So now the rent is fixed for 17 computers. Maybe because you have gone for higher, your per computer rent has been reduced. Volume discount. Okay, possible. Then on a separate note, it is also possible that you reduce from 10 to 5, 10 to 6. Okay. I don't want 10. I'm surrendering 10. I want only 6. So please take this back. Okay. The period of lease, as I said, early termination, cancellation option, extension option. So you have to see reasonably what is likely to happen. Even in that, number of items lease, period can be curtailed also. We renegotiate and say, I want to modify from 5 years to 3 years or 7 years to 11 years. So period of lease, number of items and rent per item. In fact, one of the lease contract which we had of a oil manufacturing, lubrication oil manufacturing company, they had warehouses and they had rented the space of 2 lakh square feet out of the 5 lakh square feet. And sometimes if the stock is higher, they had the option to use it up to 3 lakhs. Now what should I do? Should I take a present value of 2 lakhs or 3 lakhs? So here the fixed portion should be taken. This they may or may not use. So that is treated as per the charge on the accrual basis in that particular year. But here you have to create asset on that. So rent per item. These 3 elements can result into modification of lease contract. Okay. Modification of lease contract. So let me take an example. Suppose there is 1 lakh rent payable every year for 5 years. And we are saying that discounting rate is 10%. So the today's discount we will have to take 1.1 raised to 1, 2, 3, 4, 5. Divided by 1.5 raised to 1. Now I am calculating the present value. So the present value comes to 379. So I will create a ROU, right of use of asset, debit to lease liability. Lease liability. We will take a figure of 379. Are you with me? What will happen to this? Subsequently, we will depreciate it. So I'll show you the impacts. When we depreciate, now interestingly, though it is a right of use, so looks like an intangible, but the word used is depreciation. So we will say divided by 5 years, and then reduce this. Then carry forward. And at the end of 5 years, like a normal asset depreciated, it will become 0. I'm making a mistake. It is SLM here. Yeah, it will become 0. On the other hand, the lease liability will go based on unwinding of discount. That is, we will charge interest of 10%. And the lease rent will be taken as a repayment. And the balance of the liability will be calculated. Carried forward. This is something I'm sure you might have learned into IFRS 9 also, or Ind AS 109 also. and likewise this liability should become zero. Now look at a situation where, as per the previous treatment, we were charging to P&L 1 lakh. Okay. And now that will be replaced by depreciation and finance cost or interest in our simple language. So the depreciation will be like this and finance cost will be taken as this. So if you stretch it, and take a total of this, can you see here that in the first years, this is more than, first 3 years more than 1 lakh, and then it comes down. That is called as, especially on the interest side, it's like a diminishing balance. So while the total of both is bound to be same, 5 lakhs, 5 lakhs, and this plus this is also 5 lakhs. Still, the yearly charge, it means that most of the companies who were leasing the properties, suddenly their P&L got hit by a major amount. Okay. So that is the beauty of this standard, that it takes upfront hit in terms of having a charge to P&L, and it also increases assets and liabilities. The assets, of course, are non-current assets, while liabilities are split between current and non-current. The next 12 months payments comes as current and balance as non-current. So many impacts. P&L hit negative. Okay. Assets non-current go up. Liabilities current go up. Non-current go up. And hits current ratio. So bankers are also going to have a challenge. Current ratio gets bad hitting. Okay. Because they feel now the liabilities are higher. Now, in a way, it is good for banking system to know the long-term implications. And in case of M&A or in case of owners, they should know the long-term likely liabilities. Okay. Having said that, I will come back to these three factors and say that whenever we have any of these three items changing for whatever reason, okay, that will amount to a modification arising out of. Now, when will it be called modification? If the revision is negotiated in totality along with the original asset. Revision is negotiated along with totality. Now we will come to that, how to account for those. How to account for those. Because modifications handling pose a challenge not only of the new values of assets and liabilities getting created, but removing of the old values of asset liabilities and the usage of the new rate of discounting. So non-cancelable period, obviously, reasonable certainty of being exercised, and termination option, reasonable certainty of not being exercised. That way can be an original presumptions. Now this non-cancelable period plus period covered by extension and termination options should be used for revision. There could be some other options, some new option comes into picture that now you can use the vehicle nationally and I'm increasing your rent, or we are allowing you to use car in the third shift also. Okay, the company started third shift and you can use the passenger vehicle for that. Or in a KPO, employees residence wise pick up and drop facility was provided at night. So all those things can make a difference. That reminds me of one example. एक जैसा मुझे याद आ रहा है, we were doing the Ola cabs IFRS, and when the question came, जैसे आपका ये एयरलाइंस रहता है ना, like your airports, in the airport when you come on arrival you see the cab hiring stalls. So अकबर रहता है, प्रीपेड वाला काली पीली रहता है, then मेरू रहता है, and now we have Ola, Uber, Red Cab in some cases, or maybe some more also. Now when you come out, the first one is Akbar. Now everybody knows Akbar is very costly, so people don't go there. They come to prepaid Kalipili. And then they go on for Meru or Ola or Uber. Now one day, Ola offers higher rent. So Ola comes here. And Akbar is posted here. Okay. Now Ola has a contract for 5 years. But you see the catch in the contract is that you are provided 20 by 20 space to put your stall on the designated space. However, the designated space can be shifted anywhere in the airport to be decided by airport authorities. The question came up, is it an identified asset? Airport is one, but the business impact is a lot when you are here and when you are here. Because arrival, the first choice is people want to immediately book a cab and go back. So it did not amount to identified asset, and Ind AS 116 not applicable. Okay. So you are not to create asset and liability because the designated space has economic impacts of changing. Does it mean that economic impacts of changing are there with a discretion? Then can it be treated as not covered by lease? You can't say that exactly. It says that if the chance is that you are can be put only in a more beneficial place, then you can take as a, or you will be compensated for the loss due to space change, then you can call it as an item falling under identified assets. So remember this, because there are many things, where people try to do the 3 years computation only, though the period is 10 years. Then we come to variable rent, variable payments. Should the variable payments be considered for calculation of present value? Frankly speaking, no. Because the variable payment may depend on anything, revenue, profit, whatever, capacity. Then based on index and rate. So if the index and rate is there, then you should consider. So for example, municipal index, municipal rate per square foot. If you link, then yes. The lease liability and the right of use asset, okay, should be adjusted to the incentives. Also, initial direct cost. A machine is brought and installed by the lessee, that is also capitalized as a right of use of asset. Then estimated cost of dismantling. This we have studied in the standard of PPE, that is also to be capitalized. Then residual value guarantees. If there is a purchase option, then reasonable certainty of exercise. So everything goes into a question of management judgment than any rule-based situation. So if you expect the termination penalties, then yes, even they are to be considered. Then we talk about cost model, or you can have fair value model. In a cost model, we will do the cost less depreciation and impairment and the remeasurement of lease liability. Should the remeasurement of liability be done because of the change in discount rate every time? Answer is no. It is like an amortized cost treatment. So one has to have discounting originally done, unwinding has to be done at the same rate. But wait, I'll use one word here called except. Except where modification happens, which is not a completely separate contract. Depreciation provision, same as property, plant, equipment. Transfer of ownership happens at the end. Then you'll have to look at the purchase options and probability. Okay. Then, if in property, plant, equipment, we have studied that the electrical machinery can be a separate class of asset, or office building and factory building can be separate class of asset. But class of asset wise, you have to have same model, either cost or revaluation model. Here it goes one step further and says that if a particular asset on a cost model is used and a similar type of another asset was taken on rent, that should also be taken based on cost model. So same class of property, plant, equipment has to be using the same model. Okay. As far as investment property is concerned, the fair value model still Ind AS doesn't allow, so the question doesn't arise. but disclosure will be needed. Where do you show right of use of asset? Right of use of asset, where to be shown? So let's say this is the asset side. In that, there are non-current assets, and in that there is a PPE you can show as owned and leased. Then investment property you can show as owned and leased. Other option is you can have assets here, non-current assets, property, plant, equipment, and investment property. And here maybe note 17 and note 18. So in the notes to accounts, in 17 will show the breakup of owned and leased. This. So two types of presentations are made available as a choice, but these are presentation choice. These are not accounting policy choice. Subsequent measurement of lease liability. Now, subsequent measurement of lease liability attracts very complex provisions. So, reducing the payment made, increasing the interest, remeasuring the modification, blah, blah, blah. And then the difference is to be taken into the P&L. All these things pose a complex issue. But I will share with you how do we handle that smoothly and easily. If the discount rates are new because of lease term change or change in assessment of options, then revised discount rate should be taken. But residual value guarantee change or future release payment on account of index change, that is not to be considered for revising discount rate as a modification. Now, a separate lease treatment and modified existing right of use asset have to be dealt separately. How do we deal with that? We will discuss that. From the leaser's perspective, let us focus on leaser. The classification is finance and operating. I suppose those who know the previous standard must be familiar about it. So 5 plus 3 cases are there wherein the finance lease actually is not a lease but is a sale and purchase. So one of the most common is lease term is equal to major part of economic life. If that is the case, or the rest ones are more tricky, but finally aiming at transferring the control. Now it is a really big debate. When should we call it a finance lease transferring the controls? Okay. And what are the implications of that? So here I will make one thought process in your mind. An asset can be used, sold or resold, then pledged, then what else? Hold, then scrapped, what else? Use in conjunction with other assets to enhance the value. Reduce expenses. Now the main part is if you do not allow to pledge, sell it, resell it, has the control transferred. And if not, the leaser cannot book it as a sale. Of course, these are all substance based, but I will make wherever the lease period is equal to useful life of asset, is it essentially a finance lease? One has to go by substance. All right. Then we were talking about the benefits incidental to the ownership are coming in operating lease. What will initial measurement be treated from the leaser's perspective? That is net investment in lease. A beauty part is that in case of an operating lease under Ind AS 116, the leaser depreciates, say PP, and leasee depreciates ROU. So indirectly, it in a way amounts to double depreciation if you talk nation as a whole. But Ind AS believes that mirror concept need not be there. We have this habit of two parties doing the transaction should have exactly opposite entries of each other. They say sorry. It cannot be. It cannot be like that. I will share with you an experience of a company whose name is Control Prints. This company is in Mumbai. We were training them on Ind AS. They produce printers, not our normal printers, which can be used on 3D printers or cloths, complex items printing. Now, when they produce a printer, they would like to sell it. The life is something like 20 years. But if could not be sold, then rent it. Now, when they rent it, let's say the rent is only for 5 years. Funny part is, original intention after the production, it was lying in inventory of Control Print's balance sheet. But once it could not be sold, it was moved to PPE and the leaser treatment started. After 5 years, the item came back. Now again they wanted to sell it first, so was moved to inventory and sold. But suppose it did not get sold for 1 year. Again they say rent. So as a leaser, move to PP. And again the depreciation starts. So you will find a very funny situation that whenever it is in PP, it is rented and depreciated. And when it comes back to inventory, it is waiting for either sale or for renting, with first choice being selling. For that period, it remains in inventory and measured at cost or NRV, whichever is less. So for the same asset, you may have a situation of asset and then inventory, where the leases book is calling it as a ROU asset. So this was one practical case we faced in Control Print, a famous company in Andheri. Then, as far as leaser is concerned, they book it is a finance income. Okay. And then, if it is paid based on rent, then it, but wherever it is an operating lease, it is a straight line basis of the income. Okay. So there is a no mirror treatment. So if you take leaser, lessor and lessee, here in a finance lease, they will book sale. And in an operating lease, they will book as a rent income, but these people will capitalize ROE. Right? So they will have asset in both the cases. All right. Okay. Now remains the one of the tricky areas, sale and leaseback. Here we will try to take an adjustment with an example, but I'll take that at the end. Then, apart from sale and leaseback, I said that we will discuss one more possibility of modifications. So I'll take a few examples based on that. Okay. So are limited, leased, or taken on lease, taken on lease, 4 helicopters at, I mean, helicopters renting is quite funny. So let's say 1 lakh. I'm simplifying for calculation purpose. For 7 years. Okay. Now, they have extension option for another 3 years. But those extended years, there will be a rent of 1,20,000. So how do we calculate? And at end of 4th year, it was decided to opt for extension. Yeah. So originally, what do we do? 1 lakh, and then that figure remains constant. Presume that the discount rate is 10%, and then it is 7 years. 1, 2, 3, 4, 5, 6, 7. And then what we do? We discount this. All right. So we have the first ROU entry passed for 486. I am not presuming any other direct cost. So ROU is 486. This divided by 7 years. This divided by 7 years. And then we calculate the situation up to 4th year. Okay. Now, when it comes to liability, the situation is little different. Situation is this into 10% minus 1 lakh. So in 4 years, we reach this situation. Obviously, assets and liabilities are not matching. Liability is much more than asset. Now there is a modification which has happened, extension term at 120. So what is going to happen for the future? For the future, we are going to pay 1 lakh, again 1 lakh, again 1 lakh, 5th year, 6th year, 7th year, and then another 3 years at 1,20,000, 1,20,000, 1,20,000, 5, 6, 7, 8, 9, 10, 3 years extension. Now you need to consider the rate of say 12%. Now the discount rate has become 12%. And the modification of term has happened. Okay. With the increased rent, so we took the increased rent also. So present value at the end of 4th year is like this divided by 1.1 raised to 1. And we will fix this figure. And then we will bring it here and come to a situation of totaling this. This amount I need to carry as a ROU debit to lease liability credit. Okay. So then what do I do with this? I will give you a simple solution. Simple solution is liability to be closed, lease liability debit. Take this figure here. Then asset to be closed, ROU. What is the difference? Credit. So to gain on modification. The standard makes it very complex, but I am telling you a very simple method of recording the modification. So modification can be for the term or number of items or extension period to be sought, etc., etc., etc. Or change in the rent number period, and accordingly close the modification at that point. Both asset and liability as outstanding on that date. So when I read this standard first time, I found that my God, it's very complex. But subsequently I realized that it is not that great a deal. Okay. So don't get too much bogged down by Ind AS 116, though I will now come to sale and lease back. Now I remember we also used to have this as a headache in case of sale and lease back, even in the old standard. Now the problem goes up further, and what it says is that the required treatment has to be based on model. Okay, so let's say an asset of 2 lakhs was rented. This was on cost model. Now, on this was the old asset. On leasing date of lease, on date of lease, its fair value was 4 lakhs. Okay, its fair value was 4 lakhs. The question came up that the asset was sold for 3.60 lakhs. Sorry, fair value was 3.60 lakhs and sold at 4 lakhs. What should be the treatment? Because it was leased back for 5 years. Okay. The asset has a remaining life of 20 years. Remaining life was 20 years. It was rented for 5 years. What should be done? In terms of keeping the asset in the books and how? So it was leased back. So you will create a ROU. Now ROU will require a rent. So how much will be the rent? So let's say the per annum rent was 30,000. Okay. So first entry we will pass is bank debit sold at 4 lakhs to PPE. How much? 2 lakhs. To profit. How much is the profit? Now profit is equal to fair value minus cost. So 1,60,000. And to what? What is this? This is actually not a profit. This is what? An adjustment to lease rent. So call it a lease rent adjustment or keep it as a liability. 40,000. Are you with me? Now, I take 30,000 and let's say again for simplicity 1.1, 10% discounting rate and apply for 1, 2, 3, 4, 5 and then calculate the present value. All right. So that gives me a present value of 1,12,000. 1,12,000. Now an asset whose fair value is 3,60,000 over 20 years means per annum is 18,000 and 5 years would have been having a 90,000 rent, but now it has gone up to 1,13,000 payment. But this 40,000 is already paid as extra rent in advance. Can you see that? So I will add here another 40,000. Okay. And it will not have any present value because and this rent, which is a discounting facility, is now recorded as ROU. ROU debit to lease liability credit. Now the question is it correct to record the ROU at this value? And the answer says no. Because your cost model was giving 2 lakhs, fair value model gives 3,60,000, and for 5 years it becomes 1.5 lakh. Indirectly, this has gone at fair value. So therefore, we should keep the lease liability same, but reverse the profit. Reverse profits. What are the profits on sales? 1,60,000. 2 lakhs as to 1,60,000. So we should break this figure. I'll take this figure here and allocate 2 lakhs, sorry, 1,60,000 out of 2 lakhs. 2 lakhs as against 3,60,000 and 1,60,000 against 3,60,000. All right. So I need to split this figure. So we will use a ratio and split this figure. Okay. So thereby we will arrive at ROU of 85,000 and profit reversal of 68,000. So the profit which I should show is not 1,68,000, but I should reduce it by this much. So this will become a combined entry actually by way of netting of the profit. So if you take now combined entry, I'll just copy and paste here. And now profit we are replacing by 1,60,000 minus this, so 91,000, and we are bringing the liability of 1,53,000, but that liability is already there. Okay, and the ROU creation of ROU debit 683,85,402. This is how one will have to give the treatment. Are you with me? So that is all about sale and lease back. The primary principle which is required to be maintained in mind is the asset getting sold at fair value and coming in the books as a right of use cannot be valued at sale value, because that becomes sort of fair value. So should be brought down to cost, and therefore to the proportionate extent we need to adjust the profit on sale. All right. So a lessee who sells and lease back may end up in having a asset value increase indirectly, smartly. As a practicing auditor, we don't allow that to happen. Rest of the terms, if you have practiced the past standard, they must be easy. For example, ownership transferred at the end of lease terms, or option to purchase asset at less than fair value. Many times it is eyewash. See, all these lease standard came because there was a need to distinguish between sale and lease. And now the new standard creates the lease for long-term commitments which an organization can have. Arising out of this, or there can be some assets which are specialized assets. I will give an example of Crompton Greaves. We used to have some components needed to be incorporated in the low tension panel or switchgear. And for that purpose, we were required to get a supplier to provide that. But the supplier won't be so much knowledgeable. So supplier along with Crompton's design engineers will create a design of a tool, and the supplier will buy make that tool by investing himself. Now that tool, okay, when he uses it and he gives it to Crompton's for lease to produce those components, or he produces on behalf of Crompton, there is a case of tool which is rented. Now this rented tool is a specialized asset. Crompton says, I won't buy it, I will rent it for 3 years only. If it works, fine. Now supplier says that it has a life of 10 years. So why 3 years? Crompton says sorry. So he indirectly, what he does, the 10 years lease rent or recover full cost, he covers in 3 years itself. Now you must have heard the situation of Russia-Ukraine war. Lot of European countries have rented the aeroplanes to Russia, and those aeroplanes are lying on the airports of Russia, and the companies who have leased those aeroplanes to those airline companies have very complex clauses. That is, in a war situation, what should be done? You have to use means you have to pay. Now those companies are no flights happening because they are banned. They have to pay the lease rent. Can we pull out a force majeure clause? And if they say, look, I want to surrender and I am ready to pay you the price, that pay you the price, how will it help? Because they are not able to get back the aeroplane. So premature termination is not possible. And even if, let's say, Russia allows it to fly, where is the oil? And if the oil is also available, when so many flights are cancelled, who is going to take those on lease? But these are all unique situations. Ind AS cannot find solutions to these cases. Even when COVID happened, there was no really solution. Finally, going round, we finally came and said that give a disclosure note. Because many places it was reduced. Was the reduced rent was a modification or not? How to treat that? It was an abnormal circumstance. So the abnormal circumstance, should it go as an abnormal item or should it go as a disclosure note? What does Ind AS allow? With a lot of study, all the committees and EAC and everybody came to a situation of providing it on the basis of disclosure note. A interesting part comes out sometimes when the residual value guarantee is not likely to come. Where does we should understand guaranteed amount, unguaranteed amount. What does it say? This situation arises when the leaser and lessee's place of work are far. Let's say a Delhi party rents a machine to Chennai, and at the end of the lease period, they guarantee the residual value saying that I will buy it at that point at fair value, but that amount is fixed now. But there's no option. Now, many times, Delhi company, if the fellow is not ready to buy at that price, is playing a gamble, because for them to bring it back, the transport cost is so high that they rather prefer give me a value guarantee and you take it. Then we have come across a situation that was when I was working in Surat, Navin Florin. We have rented some machines, and the agreement was that rented machine has to work 12 hours per day. Now the machine was failing after 8 hours, after 7 hours, but that was a very critical process for us. So we were not ready to return. At the same time, they were saying that as per the contract, you have agreed to, if the performance doesn't match, then you have right to return. So you return it. But we were in such a situation, we couldn't return it. So we renegotiated the rent for the change in performance. And then finally what happened, since we needed it, we rented one more machine at the high cost. But the benefit was that the critical process saved us a lot of money. So should the rented place, a rented item, how it will be treated? And if it is between holding and subsidiary in the form of a right of use, then what should be done? In consolidation, it all vanishes. So you will find many companies, one P Limited has subsidiary called R Limited, and R Limited takes it on lease, okay, finance lease, or rather buys it, and P takes it on an operating lease. Because nowadays what is happening, the parent companies want to show their balance sheet as a very light balance sheet, and that is where then the consolidation terms come into picture, and then they cancel all that thing to show a correct picture. All right, I think covered almost everything. Are there any queries? Let's give a few minutes for queries on both the standards.
मिश्रा जी कुछ क्वेरीज है?
हेलो,
Yes sir.
या कुछ क्वेरीज है क्या सर?
हाँ सर, है सर,
बोलिए ना.
दे रहा हूँ सर.
स्क्रीन शेयर करेंगे सर.
All right. Should I stop screen sharing of mine? Is it needed?
मिश्रा जी
स्क्रीन शेयरिंग कर रहा हूँ सर, क्वेश्चन कॉपी करके दे रहा हूँ.
तो मेरा स्क्रीन बंद करना पड़ेगा, तो करता हूं. ओके.
वंडरफुल सर, छान होतं सर लेक्चर, एकदम मस्त होतं.
कौन बोलता है?
बिपिन मुंदड़, आई एम कोऑर्डिनेटर सर.
बिपिन जी नमस्ते. थैंक यू. सो ती क्वेरी दाखवत आहेत का? ती शोइंग द क्वेरी.
स्क्रीन शेअर करणार, त्याने सगळे कंपाइल केले आहेत चॅट बॉक्स वरून आणि तो
ओके
शेअर
ओके
करणार.
ओके ओके. Okay. So while he is typing, I mean copying, I will start answering the queries which you have already typed.
Yeah,
If
you
a
can
company
read
is-
and answer,
I can
sir. You
read,
can
yeah.
read.
If a
Yes.
company is selling goods with free warranty, then whether warranty provision needs to be created or deducted from revenue as per Ind AS. Now, this is a big chalugiri. Okay. And क्या करना चाहिए और क्या करते हैं, ये दोनों चीजें काफी जगह अलग रहती है. बट बीइंग अ प्रिंसिपल्ड प्रोफेशनल, आई विल टेल यू द स्टैंडर्ड्स प्रोविजन. ओके. अभी वारंटी क्या रहता है? वारंटी मतलब क्या है? प्रोटेक्शन अगेंस्ट मैन्युफैक्चरिंग डिफेक्ट. It's a kind of guarantee that if there are manufacturing defects, we will replace or repair it. So generally, manufacturing defect होगा और आप machine use कर रहे हो, then you will come to know within a span of 6 months, 1 year. So logically, the warranty should be for, let's say the machine is of 10 years, the warranty should be of, let's say 6 months, 1 year. But आजकल क्या trend आया है कि people say lifetime warranty. बोलते हो यार, what is lifetime warranty? Are you saying that even in the 10th year there can be a manufacturing defect and you are taking responsibility of that? For what purpose? But करते हैं. I mean, a famous company like LG also does it. So if you are selling really repair maintenance services or annual maintenance contract or repairs contract or after sales service, by calling it warranty, then it is not really warranty. So now we are talking about a pure warranty in your question, and saying that the pure warranty is only for manufacturing defect and should be for a very short period. In that case, the presumption is that the warranty cost based on the past experience, that is historical, current and forecast points, I mean trends, etc. basis, a percentage should be provided for as an expense. So provision should be created. Deduction from revenue is not needed. In fact, deduction from revenue is needed where warranty के नाम पे आप annual maintenance contract या ऐसा कुछ ले रहे हो तो then you need to split the performance obligation. In fact, this query had come to me because at one time LG CFO also was my student in my personal classes. So that time I said, तुम वारंटी क्या लगा रहे हो 10 साल का? 10 साल का वारंटी किस लिए चाहिए? So there's a misnomer created of warranty for full lifetime warranty. Warranty doesn't mean that. Warranty, thoda bahut extended warranty, one can understand. And in that case, the real warranty in its sense, protection against manufacturing defect, amounts to making expense provision and revenue is not required to be deducted as per Ind AS. But if I am a chartered accountant in practice and the client tells me, please certify my accounts, I have made a provision. But if you find in substance, it is not really protection against manufacturing defect, read through the agreement carefully and tell the client that repairs and maintenance services provided are not warranty. Okay. So warranty may be there, may be minuscule portion. So there's a misled. Generally, the vehicle industry, they enter into sublease arrangement for particular total production capacity, whether this will be covered under lease. Also, there is some minimum guarantee for using a particular number of cases, and any shortfall can be adjusted against future offtake up to certain period. How to recognize revenue? Now the question is that liquor industry, here I am presuming that it is not a liquor that I'm saying that customer says bill and hold, keep this wine on my behalf for 10 years. I want 10 years old wine after 10 years. We are not talking about that. I am presuming that the produced capacity, okay, let's say you're producing 1 lakh bottles, then we are reserving 30% of that production capacity. Okay, and the liquor industry has entered into a sublease arrangement with the others. Then the particular number of cases, now you are turning to revenue. How to recognize revenue? Revenue happens by 5-step revenue recognition. Is it an identified asset? No, because production capacity में कौन सी bottle आपको देंगे उसका सिक्का तो नहीं मारा है. So the moment we say that it's not a particular item which is reserved, then it becomes as a stock and sale item, and therefore revenue should be recognized only on, in a way, the offtake. Okay. Then in the given example of Andheri Printing Company, what treatment was finally given? No, it was changing every year. PP to inventory, inventory to PP. Okay, so situation as and when changed, it kept on getting changed. The name of the company is Control Prints. It is a well-known company. Balance sheet is available. You can see. In case of gain and loss or modification, is it to be considered? No OCI. No OCI at all. Okay. Because you know this has become like a Washington's axe. एक बार हमने पहली बार OCI क्या सीखा, हर एक चीज हमको OCI में डालने की इच्छा होती है. No, OCI has 8 fixed items. Anything more than that doesn't go to OCI, and those items you must be aware, that is revaluation reserve, actuarial gains losses, financial assets, change in fair value, financial asset debt, change in fair value, financial liability, own credit risk, forex operations translation, cash flow hedge. So these are the 8 items which are in OCI. You cannot add any other item in OCI. If you want to add, please apply to ICAI for amendment to Ind AS. How to determine percentage of completion? Will it be determined basis of cost incurred or on the basis of work completed? See, as I said, the performance output method and performance input method is the same thing what you're calling as cost incurred or work completed. But the professional companies always go by work completed, because they get the third party surveyor's report, and they, even in Gammon India, we used to get surveyor report, because cost incurred as a proportion of total estimated expenditure can give a very funny picture if there are cost overruns or even cost reductions. You may not be able to derive really the billable amount or accrued amount. So while both the methods are allowed, it is, as a professional, I will say, I will recommend and go by work completed. Okay. Suppose 40% of the cost I have incurred in ground floor and building of the 10th floor, then what degree of completion is 10% of 40? Yeah, I mean, here, these both the clauses don't come into picture. How much is your enforceable right to payment? Because the flat benefits are not transferred. So let us say 10% of 40. Now, because the building is of 10th floor and you incurred 40% cost, the 40% cost incurred in ground floor may or may not be the milestone. The milestone may be 5% for basement, 2% for walls up, 15% for walls up to the top, then beams are created. So you will never come across only ground floor as a created. You will see always the walls taken up to the height. So you have to therefore go by enforceable right to payment, because the control of asset is not creating any benefit to the buyer. Then Ind AS, we used to measure on the basis of cost incurred. Yeah, cost incurred is one thing, but today the cost incurred, especially of the type of assets where there is no benefit getting transferred. I gave an example of Bangalore and Express Highway versus flyover and flat. Flyover and flat, you cannot get the partial benefits. So therefore, this enforceable right to payment from the seller's angle, that clause was brought in to take care of such cases. If you have right to payment, you book to that extent, provided it has reached that stage. And if advance is given for sublease in legal industry case, which is to be adjusted as a percentage of revenue, whether advance needs to be accounted for as per, whether advance is needed to be accounted for. And if you are asking me how much advance to be adjusted, it purely goes by terms of payment. Okay, because terms of payment you cannot mix up with receivables and revenues. Revenue goes by control transfer. Payment terms are decided. Sometimes the payment terms are that advance will be adjusted in the first bill itself or the last bill or proportionate basis. So it has to be seen in case of the liquor industries agreements which are done. There is no Ind AS 109 to tell how much should be done. But if you are saying that there is no specific mention, then you go to section, I think 56 of Contract Act, which talks about appropriation of payments. The principles given in that to be followed, either the specific bill basis or FIFO basis. In that case, the whole thing may get adjusted. So that is why most of the big companies are very cautious on the advance adjustment clause as given in terms of payment. I hope my answers are clear.
Yes, yes, sir. Thank you so much, Rammohan Bhave, sir. Sir, today's lecture, as it was said initially, lease and revenue, particularly is Ind AS 115 about lease. It is very difficult to understand first, and then learn the Ind AS 115. But you made it very easy with the help of practical example. Not only some imaginable example, but on-field practical experience. With your rich experience, you could narrate very nice experience and made it interesting. Sir, for the time devoted and knowledge shared, on behalf of WRC and on behalf of all participants, I propose hearty vote of thanks. Thank you so much, sir. Thank you.
Thank you. And be in touch anytime any audience wants.
Yeah? Yes. Thank you for this session. Thank you.
Actually, I should thank you for the opportunity, because I believe that knowledge shared increases.
Wonderful, sir. Wonderful.
Thank you.
Yes, you shared without any boundaries, sir. You shared without any hesitation or any keeping something with you. You shared very open.
I am 65.
We wish you long and healthy life, sir. Thank you so much, sir. Thank you. So meeting is over. Tomorrow again, everybody join at 4 o'clock. Thank you.